Hey, I'd like to welcome you to another episode of Money Matters Top Tips for Success, where each and every day I bring on new business owners, entrepreneurs, and executives and have them share their top tips for success with you. My name is Adam Torres. You can follow me on Instagram at Ask Adam Torres. Keep up with my book releases, book tour schedule, signings, all that other good stuff. Always love to connect with you there. And as always, if you'd like to apply to become a co-author of one of my upcoming books, just head on over to the website, moneymatterstoptips.com, and click on Become an Author to apply. All right, so today I have Brett Swarts on the line, and he's founder over at Capital Gains Tax Solutions. This is a very special reunion 2020 episode. What does that mean? It's when I bring on a guest that I had on in the past, and I couldn't get enough of them, so I brought him right back. So that would be Brett today. Brett, welcome back to the show.
Adam, thanks for having me.
Man, it's great to catch up. I was like, new year, 2020, new decade, Capital Gains Tax Solutions. I think we're going to have a good show. What do you think?
I think so too. You know, the marketplace is still very strong and high, and values are very high, and so there's a lot of capital gains tax out there to be deferred.
So let's just jump right in. So let's get into what you're doing over at Capital Gains Tax Solutions. So first, for the listeners that didn't get a chance to hear the first one, I think we recorded that about a year ago now or something. Like, it's been a while. What's going on over at Capital Gains Tax Solutions? Let's start there.
Yeah, so most high net worth individuals who own high and primary homes, commercial real estate, or businesses, you know, they struggle with capital gains taxes, somewhere between 30 and 50% of their gain when they go to sell. And we use a deferred sales trust to get in tax deferral, liquidity, diversification, and for some of your listeners who own commercial real estate, the ability to eliminate the need for a 1031 exchange so they can create and preserve more wealth. You know, there's a stat that the American Banker Association found when they did a survey that there's about $17 trillion that's going to pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And it's by the baby boomers. And a lot of them are looking to retire. In fact, there's about 77 million in the U.S. alone and about 10,000 turning 65 every day. And they're tired of the toilets, trash, and liability. A lot of them are, and they're looking to pass on to the next generation. But they feel trapped, right? Because if they sell these highly appreciated assets, they're looking at, again, the 30 to 50%. So their gain being wiped out by that tax. So we come in and we give them this tool to give them a lot of flexibility and a lot of options so they can create and preserve more wealth. And let's face it, so they can be a little more passive in their life and enjoy their wealth.
No, that's awesome. So let's, I don't want to assume that everybody listening knows what a deferred sales trust is. So let's do a little primer here. First, let's define that.
Yeah, so deferred sales trust is just a manufactured installment sale, or a way to your listeners might know about it is a seller carryback. So, the IRS gives us certain tax loopholes, legal loopholes to help stimulate the economy and keep money flowing versus just be putting in a bank and sitting there. And the ways they do that, they say, hey, if you can put it into investment property or other businesses or the stock market, and use certain tools, we will allow you to defer the tax, and in other words, it's going to grow the economy. So on the big macro level. So in this scenario, you carry a note. So imagine Adam was selling a property for $10 million, and he decided to carry back paper. Let's say I gave you a $2 million down payment. In that scenario, you'll owe tax on the $2, Adam, because you've received the $2. But on the other $8 million, it's in a deferral state. The difference with the deferred sales trust is we actually have a cash buyer lined up, ready to go, about to buy it for you for $10 million. But instead, the trust jumps in between, and it actually buys your position for $10 million, and you carry a note back for 100% of the financing. It gives you a zero down payment. And because you took a zero down payment, Adam, you haven't received any of the principal balance. Therefore, you're in a tax deferral state. And then immediately, the trust turns around, and it sells it for the same price it bought it from you. Bought it for 10, it sold it for 10. And therefore, there's been no taxable gain for the trust. And the buyer takes title the same way he would have either other way, and he's happy, he's gone. But now you have a whole lot more flexibility, a lot more benefits. And the number one being you can buy at optimal timing. And what does that mean? Well, that means you can purchase property maybe when it's more of a buyer's market, right? When the market shifts. I think most of us would agree, especially here in California where we're located, it's definitely a seller's market. Prices are through the roof. And it's very hard to find value-add forced appreciation opportunities that make a whole lot of sense to purchase. And so, especially for a lot of our California clients, they're selling highly appreciated assets. They're going into the deferred sales trust, paying off all their debt along the way, and now they're being able to diversify that into stocks, bonds, mutual funds of their choosing. But even better, out-of-state real estate, right? Passive commercial real estate deals that have excess of 10% cash-on-cash returns. in areas that are not as highly appreciated, such as, the coastal states. And so now they're not only creating and preserving more wealth, but they're also achieving what a lot of them want, which is more of a passive lifestyle.
So for the listeners here, so now the assets are in the trust. What kind of things can they invest in while the assets are in the trust? Does it have to be real estate, or could it be other things? Can it be a mixture of things? Give us some more feel on where the money goes once it's there.
Yeah, let's break that down. So first of all, it goes to a bank, and it's held under what's called DACA account, which means Direct Access Control Agreement. The funds only ever move with the client's signature. But before that, they kind of they take a risk tolerance questionnaire, and based upon that risk tolerance questionnaire, we determine how and where the funds are invested, such as stocks, bonds, mutual funds. But the best part is commercial real estate. Now, within that amount, let's imagine it was $10 million sitting there. Up to 80% is available the next day to go into your own private real estate deal of your own, or with partners, or you can invest and partner with Adam or anyone else who's a professional syndicator for either a business or real estate. You can also do ground up development. We have clients that are wanting to use the funds to develop real estate on their own. Because it's not a 1031 exchange, we don't have to follow the guidelines of equal or greater value within a short period of time. And the second thing is the remaining 20% can stay in stocks, bonds, mutual funds. Now, some of our clients will just be 100% in stocks, bonds, and mutual funds. Conservative allocations. Most of our notes earn 8% over any 10-year period of time, and net decline about 6.5%. So really it's customizable. It really just depends on what the client's needs and wants are. But here's the best part. It's adjustable along the way. So we have some clients that set it up where they're not taking any income and they're just having the interest compound, and then they're taking it at a later date. Or they're taking more income in principal and paying some in capital gains tax along the way, and some in ordinary income with the interest payment. So it's flexible and adjustable in and out of investments. And the key is we're just deferring that 30-50% along the way, and we're doing it optimal timing so you can create, again, and preserve more wealth.
And so something that you brought up is really key, and that is and so some people that are listening to this, they didn't really know deferred sales trust existed, and they didn't know that they have heard of 1031 exchange. And to me, one of the big downfalls of that is that whole equal or greater value part. Can you elaborate on that a little bit more for those that aren't quite aware what that means?
Yes. So the 1031 exchange, one of the first rules is you have to sell a piece of investment real estate, and buy like-kind investment real estate. So it does not so a primary home does not qualify, neither does a business. So let's imagine you had a $5 million property, Adam, and you're selling that, and you have 45 days to identify a couple of properties, and then you need to close on a property of $5 million or greater. Now, one of the challenges is if you had debt on that property, it means you're probably, and you're needing to take on as much or more debt. And so within that short period of time, so this creates what we call the perfect storm for the seller to get the highest price, and the worst storm for the buyer to have to pay the highest price. And so we call this the sell high, buy higher 180 days later. And it's what I found at Marcus & Millichap 10 years ago or 13 years ago when I was sitting there, and people got hammered before the 2008 crisis. What happened 2005, 2006, 2007, they loved to be sellers as a 1031 seller, but they hated being buyers. And they ended up overpaying. A lot of them got really hurt because they felt they had no other option. So our parents taught us to sell high, buy low. They didn't teach us to sell high and buy higher. And unfortunately, that's what the 1031 forces you to do. So the intent is to buy at optimal timing. The solution is the deferred sales trust, and that we can sell, not only defer all the tax, but then pay off all of the debt. So now you're debt free. And then you can buy tomorrow, day 181, or 5 years from now. So the Monday morning quarterback would have sold, let's say in 06, and in fact we had a client do this, sold in 06, and a highly appreciated property in Minnesota, commercial real estate. 5 years later, that same property was foreclosed on, and that property he bought back from the bank at 60 cents on the dollar, all tax deferred. So we like to say we eliminate the need for the 1031 exchange so you can buy at optimal timing, versus having to purchase something just because you're in a 1031 exchange.
Yeah, and that's the real key too there, and it's just like opportunity, and then and the timing on that, the 45 days, all the other things you say. I mean, it really does make it people do them all the time. I'm not against them. Let's be clear there. But that being said, unless they make sense with your particular investment objectives, deferred sales trust is a great potential alternative option for somebody that wants a little bit more flexibility and also wants more control over the long term and don't want to feel like they're forced into another property. Maybe they don't even want it times and of more value, more debt, all these other metrics that they may not even be comfortable with, but they feel they have to do just for the sake of meeting the guidelines of it. So that's one of the best things I feel is out there for them. So Brett, plans for 2020 for the company, for anything else. What's going on? Let us know what you have on the books for the year.
Yeah, we want to educate 1,000 business professionals, financial advisors, business brokers, commercial real estate operators, syndicators, and really just educate them on the deferred sales trust and help them grow their business by giving this valuable alternative that many just don't know about it. So that includes launching my podcast. We have Capital Gains Tax Solutions podcast that's launching here just in a couple of weeks. We have speaking engagements, different seminars, and our goal is just to help one person at a time escape feeling trapped by capital gains tax. We probably are also going to be releasing our first ebook coming up as well mid-year as well, so keep an eye out for that one. And that about sums it up for 2020.
Man, that's so exciting. And what's the name of the podcast again? I love to promote podcasts.
Yeah, so the podcast, and I'd love to have you on the show, it's called Capital Gains Tax Solutions Podcast. I know it's not a really catchy or necessarily short, but I just really want to just focus like a niche on different capital gains tax referral options, such as the 1031, Delaware Statutory Trust, Charitable Remainder Trust, and share deal stories from trusted, proven advisors such as yourself when it comes to deferring capital gains taxes. So we all share those ideas. And the goal is to get clarity on exactly what is best for the client by presenting each of those and letting the client decide what's best for them.
Man, that's really exciting stuff. So, Brett, if somebody's listening to this and they do want more information, what's the best way for them to reach out?
Yes, you can go to capitalgainstaxsolutions.com, and you can also search Capital Gains Tax Solutions on YouTube. I release videos every Monday, Friday on these subjects. And then LinkedIn as well. You can look at me up, Brett Swarts, and you can friend me there, and we can connect.
Fantastic. Well, hey, Brett, really appreciate you coming back on the show and sharing more about all the great things you're doing over at Capital Gains Tax Solutions. Congrats on the new podcast. All great stuff there. And I disagree with you. I do like the name, and why I like the name is because people know exactly what they're going to get for tuning in. So I think it's a great name. To the audience, as always, thank you for tuning in. I hope you get a lot of value out of this. If you did, don't forget to subscribe to the podcast, leave me a review on the Apple iTunes Store, do all those great things we do to support our podcasters. I really do appreciate it. And Brett, thanks again for coming on the show.
Thanks, Adam.